We are present in over 100 countries, and what we do is we organize events, we make publications, and we do credential programs for the certification. And our mission, what's our mission? Is to improve investments and societal outcome out of capital allocation to professional education, transparency, and leadership. That's what we do. And where we are globally, we are 12,000 members in the world. We are 31 chapters. We are here in Madrid with the Iberia chapter that I have the pleasure to lead at the moment. We are in 100 countries, and we are celebrating this year our 20-year anniversary, which is great news for all of us. At CAIA EMEA, we have a team based in Europe, based in Geneva, led by Laura Merlini, Managing Director at CAIA EMEA. I have the pleasure of having worked with Laura many years ago, having prepared for CAIA together like 15 years ago, so it's very good for me to be back here at the CAIA Iberia chapter working together with Laura and her team. Her team is made out of Nicolas, Monica, and Ivan Suarez, that's here with us today. He works in investor relations at CAIA. He's an economist. He's a student of a Master in Finance and Banking, and he's helping us with all the push of CAIA in Iberia and alternatives investment in Iberia. So I'm going to pass the word to Ivan.
Thank you very much for all of you for being here, and especially the ones that are watching the event online. Well, my name is Leonardo Cetis Ivan Suarez. Thank you for the great introduction. I'm industry relations in the EMEA region, and today I want to congratulate AFI because they've become product providers of CAIA. So now you can form yourself and get CAIA with the best hands of AFI. So congratulations, and thank you for having us today.
And probably just a little words on the CAIA Iberia chapter. We are a team of six people at the moment. As mentioned, I just started to head the chapter only a couple of months ago, but we are 5 more people with me. We have David Cienfuegos, Head of Investments at Willis Towers Watson, Ian Gutierrez, Marketing and Products in Sabadell, Vicarazo, working at Deutsche Wealth, Javier Alonso from Welcome Asset Management, and finally Cristina Alvarez, ESG, Head of ESG at CaixaBank Asset Management. So a very well diversified team of people coming from the institutional and wholesale world, asset management, private banking, and also financial advisory. We will be expanding the team, and probably in a couple of months will be 2 more people, so 8 people trying to push alternative investment to CAIA in Iberia. So today we are here because we have the honor to have Dr. Ple in Madrid. He has a huge experience in alternative investments, both on the academic side and also in the investment side. He has been advising foundations, endowments, pension funds, how to allocate into alternatives, commodities, managed futures, etc., etc. He's also Managing Director and Director of Programs at FDP. He will give you more overviews about what FDP is. And he's also a CFA and has been CAIA member for many years, also, of course, FDP Charter Hall. So thank you, Keith, for making it coming here to Madrid and giving us an overview about this interesting topic about commodities, very, very on demand at the moment. So thank you. Floor is yours.
Thank you, and welcome everyone. It's certainly great to be here with you, and we're excited to talk about both CAIA and FDP today. So at FDP, we're a financial data professional. So what we do is we train students on artificial intelligence and machine learning applications in financial markets. So half of your exam is on math and machine learning. So you'll look at classification, clustering, random forest, regression trees, and natural language processing. And then half is on ethics and then applications in financial markets. How does this work in insurance, in banking, in long-short equity, as well as private equity? So the topic of the day is commodities. And it's amazing how commodity markets can underperform for so long and then have a bout of significant outperformance in such a short period of time. And when somebody says, I invest in commodities, it's kind of hard to tell what they mean. They might mean just oil, or they might mean just gold. But when professional investors allocate to commodities, they tend to do so somewhat correlated to a commodity index. And the two major commodity indices that we see as institutional allocations are the S&P GSCI and the Bloomberg Commodity Index. And both of these include over 20 different commodities, and they're generally mixed between energy, food, industrial metals, and precious metals. What we see is that the GSCI has a very different weighting scheme than the Bloomberg Commodity Index. The Bloomberg Commodity Index has about a third in energy, about a third in metals, and about a third in food products, so it tends to be relatively well diversified, while you can see the S&P GSCI has over 80% of its investment in energy and food and less in metals, so it tends to be a bit more volatile and a bit less diversified. But why do we want to invest in commodities? The whole idea of alternative investments is to do something different. And to the extent that we have a portfolio that's entirely invested in stocks and in bonds, we have a very specific set of risk factors that we're invested in. And when we go into alternative investments, we add private equity and venture capital into our portfolio to enhance our return relative to what we could earn on public equities. We also know that stocks and bonds tend to have negative or lower returns during times of rising rates and rising inflation. And so if we go back over the last 20 years and we find the single months where stocks had their worst experience, we see that global stocks and U.S. stocks were down by 6 to 7% in the average bad month in any given calendar year. But what we see is that when we invest in something like managed futures tend to be positive during these times of declines in equity markets, and we see that investing in hedge funds, commodities, or even precious metals has less of a decline during those stock market drawdowns. So to the extent that we can add these other assets into our portfolio, we'd experience a lower drawdown than if we're invested exclusively in commodities. Now we see that commodities are not always positively correlated with stocks, and the idea of diversification, again, is to do something different, and a statistical way to measure the difference in our investment portfolio is based on correlations. And so if two assets are moving relatively together, their correlation is going to be near 1. But if we could find assets that have a low correlation of returns, that's going to be diversifying to our portfolio. And we see that the correlation between stocks and commodities tends to bounce back and forth around that level of 0.4, which means that commodities are highly diversifying to our portfolio. We could also break down this Bloomberg Commodity Index. We could look at precious metals and energy and the food products, and we see there's substantial diversification in that basket. That the commodities index tends to be most highly correlated with energy, but precious metals and food at different times react very differently to energy. So when we're building our commodities portfolio, if we're investing in something like the Bloomberg Commodity Index, the volatility of that diversified portfolio across energy and food and metals could be significantly less than the volatility of investing in energy alone. So if we go back over, again, a 20-year period, we see that commodities and stocks have approximately the same volatility. We see the standard deviation of commodity investments at about 16%, and the standard deviation of stocks at about 15%. So we see that they're relatively on the same level of risk, but they're really out of timing phase and out of correlation with each other. So over the last 20 years, S&P 500 was up about 7% a year. Bloomberg Commodity Index up less than 2%, but we'll see there's a good reason to include commodities in your portfolio, even though they have that lower return. So if you were invested exclusively in stocks and bonds over the last 20 years, and you had a monthly rebalancing, you'd end up with a return of about 6.2%. But if we added 5% commodities into our portfolio, took that out of our equity holdings, our return would fall just 20 basis points to 6%, and the risk of our portfolio as measured by standard deviation would fall to just 8.8%. Now, we could say we want to have a strategic weight in our asset allocation to commodities. And a strategic asset allocation weight says we want to always have the same allocation. Maybe we pick 2% or 4% or 6% of commodities, and every month or every quarter we rebalance back to that weight. And then there's no market timing required, no market timing involved. But to the extent that you do choose to be more active or more tactical in your asset allocation, there's a significant opportunity to vary your portfolio over the course of the business cycle. We see that it definitely pays to be underweight in stocks during the early recession, just as things are starting to look bad, that stocks tend to underperform. And so we know that stocks are a leading indicator that in 3 months, 6 months, and 12 months, the stock market is pointing to trouble in the economy. But what we see is that commodities are a coincident indicator, and they tend to do best at the top of the business cycle. So to the extent that you could be out of commodities late in the business cycle and out of stocks early in the recession, you could add to your returns. But of course, this timing is relatively difficult. Now, one of the downsides of investing in just stocks and bonds in your portfolio is that stocks and bonds both tend to underperform during times of rising rates and rising inflation. And so we need to look at what we could invest in order to hedge inflation in our portfolio. And before we start talking about hedging inflation, we need to say, what is inflation? And inflation is simply an increase in the prices of goods and services in an economy. And most governments will actually define that level of inflation by surveying different prices. So you might hear of producer prices or consumer prices. And so in the U.S. basket, we see that about 42% of consumer spending is on housing, and then about 16% is on food and energy. And we know that in the alternative investment world, it's relatively straightforward to invest in housing through real estate, and then it's relatively straightforward to invest in food and energy through commodities funds as well. So if we're looking for a hedge, we can get over 58% of our portfolio correlated to inflation. But of course, none of our portfolio is correlated to inflation, at least in a good way, when we're exclusively invested in stocks and bonds. What we see is that over very long time periods, and it's relatively difficult to measure the correlation of anything to inflation because inflation moves relatively slowly and these other markets move more quickly. But in a proper academic paper out of Yale, we see that the long-term correlation to stocks is marginally negative. And of course, the correlation between inflation and bonds is strongly negative because as rates rise, we see that the coupon income of those bonds is worth less in a rising rate environment. And then commodity futures tend to have a strong positive correlation to inflation over long periods of time. Now, I've done some work on inflation over the years. This is published in the CAIA blog in 2020, and I was talking about real assets, and I was talking about commodity investments in 2020, and nobody wanted to seem to listen to that when inflation was at 1.5% or 2% 2 years ago. But I wrote on the CAIA blog in June of 2020 that U.S. inflation could hit 5 to 10%. I actually named a number, and less than 2 years later, we're at that point. But what I did for this is I looked back 30 years, and I sorted by the 4-quarter change in CPI. So we see that in 25% of the quarters over the last 30 years, inflation had been falling in the U.S. By about 1.9 percentage points on average. And then when inflation rose, it rose on average 1.7% a year. And now that we've gone from 2% to 8% in just 6 months, this is way beyond our typical expectation here. But as we look at this chart in the top rows, we see that the best time to invest in stocks is represented by the S&P 500 or the MSCI ACWI, the All Country World Equity Index. We see that the stock market kind of likes Goldilocks, right? We don't want the economy too hot, and we don't want the economy too cold. Because in a deflationary environment, stocks tend to struggle, and then in an inflationary environment, stocks tend to struggle as well. So The sweet spot for equities is in that middle range where inflation is not moving a whole lot. It's right on expectation. And of course, we see that in the bond market as well, the lowest return to bonds is during the times with the highest inflation, either in the U.S. Barclays aggregate or the Barclays Global aggregate. They have their lowest returns during the top quartile of inflationary increases. So investing exclusively in stocks and bonds, you're likely to have your lowest returns during times of the most rapidly rising inflation. But if we look on the bottom, we can put together a portfolio, and we said, okay, let's put half of it in real estate, farmland, and timberland, and then let's put half of it in commodity futures. And we see that the highest return to that strategy comes during the highest increase in inflation. And so you look at the Bloomberg Commodity Index, has its highest return during times of accelerating inflation, as does crude oil and gold. We also see that NCREIF Real Estate Index has a strong return during times of rising inflation as well. So we're not necessarily advocates of market timing, but I'll show you the stats of when commodities perform better or commodities perform worse. So if you're looking for a signal as to when it's time to over allocate to commodities, or make sure you're at your strategic asset allocation, it would be when GDP growth is high and when central banks are tightening. And so because commodities are a coincident indicator, the faster the economy is moving and the more the Fed is trying to slow down the economy, the more we see strong performance from inflation, from commodities. And we see that especially the industrial metals are very sensitive, as well as energy, to this rise in both GDP and monetary policy. What's interesting is agriculture doesn't tend to have much of a correlation to Fed moves, or at least to an increase in GDP. So our consumption of food tends to be less economically sensitive than our consumption of energy and copper and these industrial metals. We can also look at this in terms of the dollar and in terms of inflation, and you see that energy has its highest returns during the times of the strongest inflation, and interestingly, precious metals have their best return during times of deflation. And of course, we prefer a low dollar, a falling U.S. dollar, when we're looking at commodity returns, because commodities are priced in dollars, and when the dollar is weak, people in other countries have a stronger currency that makes those commodities more affordable. But if we're looking at inflation protection, we could say there's other assets that can hedge inflation, and commodities has the strongest sensitivity to the inflation market. And so if we're looking at a beta relative to inflation, commodities clock in at a beta of 9 times. So it's very sensitive to inflation. But we could also build a diversified portfolio. We could include real estate, we could include infrastructure, even oil stocks and gold stocks can go into our portfolio. And we see that investors who have the greatest inflation risk, they might invest between 5 and even 20% of their portfolio in these real assets. They'll mix together real estate and infrastructure and commodities, and you could buy inflation bonds from governments around the world as well. Now, we see that the greatest exposure to economic growth is in energy and industrial metals, because it's relatively easy to produce agricultural output, and this year's supply of precious metals doesn't really matter because we don't really consume gold, we don't really consume silver, that all of those supplies are above ground and they have been for some time. And if there's a shortage in an agricultural product, maybe next year's growing season will overcome that shortage. But what we see is that energy and industrial metals, they're very sensitive businesses, and they tend to be highly regulated, right? Because what energy is. It's this oil and gas, and it's buried in the ground, just like gold and copper are buried in the ground. And people don't necessarily want to have an oil well or a gold mine down the street from them. So there might be some environmental regulations. But if the world says, I need more oil or I need more copper, you can't build it tomorrow, right? You have to find where it is in the ground. And after you find where it is in the ground, you need to get all of your environmental permits. You have to move all of this heavy equipment into place. You have to drill or mine and extract the materials. Then they need to go into the refining process. So it tends to be a relatively long cycle that demand and supply can be relatively insensitive relative to each other. So even when the world is demanding more commodities, the oil market or the copper market might not be able to immediately respond. Now, one of the tactical things we see is that this tragedy in Ukraine is having a very significant impact on the global commodity markets, because Russia is a key exporter of metals and energy, and then Ukraine is a key exporter of food products. And we see a number of commodities have more than 10 to 15% of the global supply is coming out of Russia and Ukraine, and both of those supplies tend to be relatively inaccessible at this point for obvious reasons. And so to the extent that that the global economy does not go into recession, the global economy continues to grow, if there's a demand, especially from the auto industry, from palladium and nickel, that's a very difficult price for the auto industry to swallow, as they're suffering with already supply shortages in the computer chip market. So this is a relative wealth chart of the Bloomberg Commodity Index relative to the S&P 500. And so we see that there's relatively long-lived trends in the commodity market relative to stocks. So commodities beat stocks from 2000 to 2008. And then stocks beat commodities most of the time from 2009 to 2021. So if you had that strategic asset allocation, if you at the beginning of 2009, if you had 5% in commodities and 55% in stocks, and you didn't touch it, commodities fell in value over that 13-year period. They had a negative total return at a time when the global stock market went up by more than a factor of 5. And so you would have been very underinvested in commodities if you hadn't been selling stocks and buying commodities to rebalance and get back to that strategic asset allocation weight. But we see that there's been a tremendous outperformance of commodities relative to stocks in just the last few months. And if we would go back with perfect timing into the commodities market, if we would have bought commodities at the end of the big move, COVID move down in the equity markets in March and April of 2020, stocks are up 23% from that COVID bottom. But we see that commodities are up by an annualized 43% over the last 2 years. So there's been a tremendous outperformance of commodities relative to equities since that global bottom. And so the topics that everybody seems to want to talk about are cryptos, right? Commodities and inflation, right? And electric cars. Right, and so besides those four things, right, what do millennials talk about, right? Not a whole lot, right? And so it's super interesting how we're making this transition from cars that run on oil and gas to cars that run on electricity, and it's obvious that the future is electric. France and the UK have already banned the sale of new gasoline and new diesel vehicles after 2040. And so you can make a long-term case for commodities based on your view of electric cars. So the demand for electric cars is very bearish for gasoline, and it's very bearish for lead, right? We put lead in the batteries in gasoline cars. And then in order to build an electric car, we need copper, lithium, and cobalt. And then what people seem to forget is that there's still energy that goes into the electricity that charges the car. You just think you plug it in, but there's still oil and gas and coal or nuclear or solar or something that's fueling the electricity that goes into your car. So that could actually be bullish for natural gas and increase the demand for electricity. But maybe there's not enough copper in the world. Maybe there's not enough lithium in the world. Maybe there's not enough cobalt in the world to fuel this this exploding demand for electric cars. Because if we look at electric car sales in 2017, there's 1 million in the world and 500,000 in China. And then last year, 2021, there were 6.6 million electric cars sold in the world and 3 million in 2021. So that's a factor of more than 6 in just 4 years. And we need to increase the supply of this copper, lithium, and cobalt. And people don't necessarily realize how to build a Tesla. Right? So what you need to build a Tesla, you need 63 kilograms of lithium. Just let that sink in for a second. Right? There's a very significant amount. We're using 15 kilograms of cobalt. We're using 63 kilograms of lithium and between 85 and 183 pounds of copper. And so it's a very significant demand for these minerals that really haven't been a focus of the metals market up until recently. And for comparison's sake, your laptop battery is 33 grams of cobalt, and a smartphone has 6 grams, and electric cars use 15 kilograms of cobalt. And so it's a very significant demand for what we call these real earth metals. So that's what we have today on inflation and commodities. We've seen a tremendous demand for all types of real assets, and in case you missed it, global housing prices have been soaring since COVID as well. In many places, they're up 50% just over the last 2 years, and that's going into the inflation basket as well. So I'm in the camp that inflation is likely more permanent than it is transitory, and for no other reason that inflation basket is over 40% in housing. And if the price of the houses has gone up 50% and rents have only gone up 10, right? Well, rents need to go up 50%, and that's gonna come in over the next 5 years, and that's going to be a sustainable push for inflation going forward.
Thank you very much. Guys, you have any questions for Keith?
Yeah, I have one. In 2006, Alan Greenspan wrote a book, The Hero of the Turbulence. No, if you read in the chapter number 25, it's talk about in around 2030, in the United States, we have an inflation rate about 2 digits. Yeah, the things are start to happen. Yeah, and the market, we are living in a turmoil about inflation. Do you think that the central banks will be able to control the inflation just increasing the price of the money? Because after you read something or you see the presentation, there is no way we are going to have a 2 digits inflation, and it doesn't matter what is going to happen with interest rates with bonds. So then, what is your opinion about things like that? And because it's surreal that we are going to be able to control the inflation or not.
So just last year, you could buy a house for $400,000 in some places in the U.S. With a 3% mortgage rate. Now it's $500,000 for the house with a 5 or even 6% mortgage rate, right? So you've had an increase in the price of the house, and you've had an increase in the price of the financing as well. And so now the price of that house in dollars per month, it's 20, 30, 40% higher. And so there's a significant increase in that price. And so the first thing we might slow down is the housing market. And we're worried about a slowdown in economic activity, and we're seeing that mortgage brokers are now firing thousands of people. Right? They're anticipating that there's not going to be as much demand for a 6% mortgage as there is for a 3% mortgage. And so this might be what what slows things down. But again, we're worried about the price of rental real estate because that's what's in the CPI calculation. And even if house prices trade sideways from here, we're still going to see that that sustained inflation for years going forward as it goes from the price of the house into the rent. And so JP Morgan put out a note in their quarterly guide to markets. And they said when inflation was 7.6%, not 8.6%, that they expected that maybe 4% of that would be what they call sticky, right? So a year ago, it was 2.6 for the entire inflation rate. And now they're saying that the persistent part is probably 4%. So now we think that that maybe after COVID, we might be able to get over some of these supply chain issues. So maybe computer chips will return, or maybe some meat products won't be as hard to get. But now with this Russian-Ukraine thing, right? Now we've got metals, energy, and food that are all hard to get, and that goes into sustaining inflation higher. So the question becomes, what can the central banks do? Are the central banks so far behind that inflation is persistent for some period of time? Because even if it's just housing that's driving inflation, what happens when the average worker gets a 10% increase in their rental cost for the next 3 years? What are they going to do? They're going to go to their boss, right, and say, my rent just went up 10%. I need a raise. Well, it depends on where you live, right? But in Switzerland, unemployment is 3%. Right? So what does your boss have to say? Okay, you get a raise. Because if you don't get a raise, you're going to quit. I'm going to have to hire somebody else. I'm going to have to pay them, and then I'm going to have to train them as well. And so the rental increase leads to a wage increase. And then what does that boss have to do after he gives everybody a raise? He has to raise the price of his goods and services, right? And so we see that it's probably more persistent as long as GDP demand is there. Right? If the central banks tip us into a recession, then maybe they'll be able to break inflation, but of course that would be at the cost of growth and employment.
I will have a question, actually, Kim. So we have seen a lot of bull runs in the commodity market due to inflation and also to the Ukraine crisis. Do you think there's a space for a higher movement of price in the price? And if so, which also sectors do you recommend the most? I think it's more interesting for the people that are watching us to have a specific answer on where to invest.
Well, I'm talking about commodities as a broad basket, right? And you're going to have the lesser volatility if you invest in a broad basket of commodities. But what we see is that energy and industrial metals have the greatest sensitivity to inflation. And people who are full-time in commodities, they understand backwardation and contango, right? It's the shape of the futures curve. And what we see is that when commodities are in backwardation, it means that the future price of commodities is lower than today's spot price. And today's spot price might be elevated due to a physical shortage in the market. And so what people who are timing within the commodities market say is, I don't necessarily want to pick metals or energy, right? I want to have both of them in my portfolio. But what I want to do in the energy market is I want to only invest in, or I want to overweight the commodities in the energy sector that have the greatest backwardation and the lowest inventories, right? And then in the metals market, I want to invest in the commodities that have the greatest backwardation and the lowest inventories. Because what we see in the stock market is that when there's a surprise, it tends to be bad news and the stock market sells off. But the commodities market is exactly the opposite. When there's bad news in commodities, it typically means supply is constrained, right? Whether we have, when we have an oil spill, whether there's a strike at a copper mine, whether it's Ukraine and Russia, all the news in commodities tends to be bad news for supply, which is actually predictive of higher prices. And we see that the commodities that have the highest price spikes are the ones whose demand rises significantly above the supply, which means it's the ones with the lowest level of inventories.
Thank you very much, Keith. if someone has any question online, please feel free to ask. In the meantime, I would like to point out something that we did, and it's that we have published, I have published Portfolio of the Future recently in 2022, which I advise you to read it. And one of the main takeaways of Portfolio of the Future is that out of $153 trillion that we have currently invested in alternatives, invested worldwide, only 12% is invested in alternative investments. And this shows that there is a lot of potential of growth, especially here in Spain, where we have around 5% of allocation in alternative investments. So I advise all the people that are reading us, and especially today, the ones that are CAIA already, to keep specializing and keep learning much more with the events that we are going to be organizing here in Spain. Thank you very much for coming today, for hearing me. Thank you very much. And yeah, I think this is the end of the event. Thank you all.